So that is where under Income Tax Act, we have certain benefits available like merger, demerger, and if you are able to structure our transaction under that, we end up not paying the tax. Also, stamp duty is again a very big aspect in case of a restructuring. So that is where there is a role of the tax professionals in advising the clients on the various aspects of merger and acquisition. So to take us through this, today we have Mr. Amithraj. He is from PwC, and he is a director in PwC, and he has almost 12 years of experience in the M&A advisory. And I'm not taking much of time. His biodata is already printed in the booklet. So before I start, request Amithraj to present his presentation, may I request Charu to offer a moment to him.
Hi, good morning everyone, and thanks to CTC for giving me this opportunity. So the next hour or so, or less than an hour rather, this is quite a bit of echo, I'm not sure. Yeah. Okay, what we will be covering is just give you an overview or an outline of various aspects pertaining to an M&A. So which could include whether you want to do a share transfer, asset deal or slump sale, followed by merger, demerger. And also we'll talk through if a particular transaction is there, which is the way or what are the critical aspects that one needs to consider in order to choose one of the options that are there. And basis that what could be the tax implications. We'll also try and touch upon a little bit on the recent treaty changes. And are there any opportunities still post the treaty changes to claim capital gains exemption? And I've also put out a few case studies which involve listed companies, etc. And also time permitting, we can quickly run through an externalization transaction that we have completed. What are the steps you need to take in order to flip the structure, like if you've got an Indian company which has an overseas subsidiaries, etc. How do you get the overseas company on top of the Indian company where all the shareholders would sit, and India would essentially become a cost plus sort of a subsidiary with no IP, etc. sitting there. So these are the brief contents that are there. I'll skip through. So every box here we are going to discuss in today's discussion. I'll be a bit quick. Please let me know if it is too quick to follow. So that, sorry sir, is it? Yeah. So in today's session, we'll be covering arrangement which would involve merger, demerger. Then on acquisitions, we'll look at what an asset purchase and share purchase would mean. Under asset purchase, we'll have slump sale and asset sale related discussion. Then also on the capital reorganization, which is buyback and capital reduction. This was more like the overview. So we'll quickly move on to the acquisition structure. We'll spend considerable time on this, discussing which of the two options is better and what do you need to choose in a particular situation compared to others. And also we are going to discuss this from the perspective of both buyer as well as seller, because for any transaction to happen, it has to be a win-win sort of situation for both. Because what normally works for a buyer will not work for the seller. Like what is best for the buyer may, for all you know, be the worst situation for the seller. Like how do you balance out the things and how do you bring in the commercials, etc., which we are going to discuss. The first one is what if a particular business is available for sale, or if an entity is wanting to acquire a particular business, what are the ways or modes in which it can be acquired? One is very simple. I just identify what business I want to buy. I'll pay that consideration to the seller, take over the business in form of the assets involved as a combination of assets and liabilities. Then again I can decide whether I want to take over the liabilities or simply take over the assets concerned. So this would be where I just buy the business from an entity, whereas the entity remains with the seller. Like I'm not taking over the company per se, I'm just taking over whatever assets I want. So this we end up calling it as a business acquisition. In this there are two sub-limbs. One is slump sale, where I take over entire business activity. Other one could be an asset sale. Anything other than a slump sale I can qualify it as an asset sale. So that is the way I would look at it. Other way of doing would be like if I want to take over the entire business, or the seller is saying that okay, my company has only one business. There's no point for me to sell the business of the company to you and live with the company. As well, you take over the entire company. So here what would happen is the business per se won't move. The shareholders of the company would end up transferring the shares from one to another. Whereas the buyer would hold 100% shares in the company, and that would become essentially a subsidiary of the buyer company, which can thereafter be merged or dealt with as maybe applicable or relevant. So before choosing whether to do a business acquisition or a share acquisition, what would be the considerations, or sequentially what would be the first of the steps that you end up doing? Firstly, whenever a business is sought to be acquired, we carry out a diligence. In diligence, it will span multiple things, which could include tax diligence, financial diligence. The objective of the tax diligence would be to find out whether there are any tax exposures in the company, or has all the taxes been paid, or have the positions been taken, are they too aggressive to defend, etc. Financial diligence, on the other hand, will focus both on the quality of earnings, like if particular earnings have been reported in the past, have those earnings been really earned? Because what happens is, typically smaller companies, for example, while they're functioning on their own, they would want to keep the profits low so that they'll end up paying lower taxes on an operational basis. But like 1 or 2 years before the sale, suddenly the sales will shoot up because they're readying the company for a sale. So once you're readying the company for a sale, typically the profits tend to get bloated, your closing stock gets bloated, your debtors crank up, etc. Wherein essentially you're trying to show an earnings which was not otherwise there. So the financial diligence would assess whether the quality of the earnings that are there is proper. Likewise, also the quality of assets we also end up looking at, which is whether the carrying amounts or the fair values of the assets are represented in the books, or any assets which should have been written off, being capitalized, those sort of things would be assessed. So after the diligence, likewise there will be a legal diligence, etc. So once the diligence is done, you will essentially get to know what are the exposures of a company. So what could be the possibilities? The company is squeaky clean, then whether you acquire the business or acquire the shares, there is no problem. But if the company has a lot of tax liabilities or history associated with it, then acquiring the business would be better compared to acquiring the company, because once you acquire the company, its entire history is going to come along with the company. So therefore the buyer will have to go through this pain of trying to clean up stuff that is there. So once the diligence is passed, then it is clear whether you want to do a business acquisition or a share acquisition. So the key aspects or considerations in case of business acquisition is the historical liabilities of the business will end up will stick to the selling entity, whereas you end up buying only the assets. So here again there are two types of liabilities. The income tax liability subject to section 281 does not flow into the buyer of the entity, or buyer of the business rather. It stays with the seller. And if the seller is a fairly large entity which cannot go missing, etc., 281, though the risk is there, you can be reasonably comfortable that this won't be too much of a challenge. And 281 earlier used to be fairly difficult to obtain. And also I've seen a lot of 281s which say that this particular 281 is valid subject to seller having discharged all his taxes. So it is like a misnomer, like you go apply for 281, which you want to be guarded against the seller's tax liability not having been paid. And these guys issue a certificate saying that this is valid subject to all the taxes being paid. Thankfully, in the last year and a half or so, there has been this change where the format has now been rationalized. They are going to have complete details of what are the outstanding pending demands, etc. And say that subject to all these things, this particular waiver or clearance is given, so that it doesn't become a conditional or a subjective sort of a thing. Having said this, from an indirect tax standpoint, while income tax liability tend to stick to the seller, indirect tax liabilities tend to follow the assets. So therefore, when you're doing an asset acquisition, most of the cases if the seller is like a large listed company, etc., we don't even end up doing a direct tax diligence. Like if I'm buying some business from a large company, say for example Tata's, so you can be rest assured there will be no income tax liability that will flow because company is going to be there and they will discharge the taxes that are there. What you then need to be worried about is only the indirect tax liabilities, which will say cover VAT, excise, service tax, etc., which will have some sort of a lien on the assets that are being transferred, where they can be recouped from the seller, or the buyer at the option of the department. The primary liability would be of the seller of the asset. If the seller doesn't pay, then where do they go? They end up coming after the buyer. And most of the cases where a foreign entity or a foreign entity subsidiary has bought the assets, the primary thing, though the liability stays with the seller, they'll come after the buyer because the buyer will get scared, end up paying the money and then try to recover the money as an indemnity from a seller. So this is on the historical liabilities. The other aspect is, say if I have bought a business having a book value of 100, typically if the business is profit making, will I pay a consideration of above 100 or below 100 or equal to 100? Generally if it is profitable, I end up paying like 3 times or 4 times minimum the value of the assets that I have acquired. So if I compare contrast with an asset acquisition versus share acquisition, so I'll take an example where we have paid 400 for buying an asset having a book value of 100. Like the total assets is say 100 crore, we end up paying 400 crores for acquiring. If I've bought the shares, I'll get the shares at a cost of 400, whereas my depreciation etc. remains at 100 because assets are there retained by the company which got acquired and you don't essentially get a step up. This, if I compare contrast with the slump sale or an asset acquisition, you get to allocate this 400 amongst all the assets that you have acquired. Any amount that you cannot allocate becomes goodwill, which is an acquired goodwill, and that also should be depreciable from a buyer's standpoint. So therefore this becomes a critical tax planning activity compared to a share deal versus an asset deal. So from a buyer perspective, always the logic would be to acquire the business so that you get a higher depreciation, and also you can use debt for acquiring business where that section 14A related risk also won't apply. Because if I buy shares using debt, for example, typically the debt would be used, then I'll say that shares related dividend is exempt, therefore 14A should apply. There are scores of decisions for and against which essentially say that in the absence of a dividend, 14A should not apply. But rule 8D is there, and also the litigation anyways will always continue. And in any case, typically for acquiring company, most of the cases what happens is in case of foreign acquisitions, the acquiring company will be light on assets compared to the target. Then what essentially happens is we'll have profits at the target level, whereas only interest expense at the acquisition company level, and you cannot offset one against the other. One way of getting around this is to merge both the companies together post-acquisition, so that the 14A risk goes off. And also from a tax standpoint, you can generate or recognize goodwill, which you can try and claim depreciation basis the Smith Securities decision. So there is a lot of debate whether this decision is going to stand the test of time, etc. But it is more like, we also ended up going to Harish Salva in one case where we had probably about $700-800 million of goodwill coming. The statement that he made was, this is like a writing in the sand on the beach. So long as it is available, claim it. Beyond that, you do not know when an explanation can be inserted. Because this is only one peculiar case in case of merger, where you get a step up in cost, because typically in merger what happens is the previous owner's cost continues with the buyer. Here, this is one way where you can claim depreciation on goodwill that gets recognized, which was not in the books of the selling company or the seller, but only it is coming in the hands of the buyer. That is one structuring opportunity that is there. We talked about goodwill here. Other liabilities anyways will continue. From a share acquisition perspective, the main downside is all the history, including environmental problems, income tax, service tax, any taxes that you take, stick to the company. And if you take over the company, essentially you are required to discharge all the taxes. Therefore, what becomes critical is from a buyer standpoint, the liabilities that are there, and that would determine whether you want to do an asset sale or a share sale. Again, here you will not get goodwill. You will not get interest set off unless you do a merger. And with GAR on the anvil, all these merger transactions etc. would come under scrutiny, where it is very clear that you have done a merger only for goodwill as well as interest break and avoiding or mitigating section 14A. So what I try to do is try to compare asset deal and a share deal from both buyer as well as seller perspective. Historical risk, asset deal is better from a buyer perspective compared to say a share deal. Next one is the acquisition funding interest deductibility. Here again from a buyer perspective, if I use debt to acquire a business, it is always deductible because the debt is used for the purpose of business. Whereas in share deal, we have this problem of 14A, and also most of the times what ends up happening is you may not have income in the company which is paying the interest. So their servicing of that particular interest also becomes a problem because all the income would be at the subsidiary level. Then you do a dividend, pay a dividend distribution tax of 20% and then meet that expense, which is again out of exempt income you're ending up paying interest expense. So cherry picking of assets, generally this is important where say I don't want to buy the entire company. I want to buy only one of the division or two of the multiple divisions that are there. Here what essentially happens is share deal as such will not be an option because if I buy the shares, I buy the entire company. So if I still want to do this as a share deal, it has to be a two-step process where I demerge whatever business I want into a new entity and then acquire the shares in the new entity concerned. This vis-a-vis if I do an asset deal, I can always buy out the assets what I want, cherry pick and acquire whatever assets are required. So carry forward of losses, always under the Income Tax Act, the losses stick to the entity. They do not stick to the business or move along with the business. Only places where losses pertaining to one company end up moving to the other company would be in case of merger or a demerger subject to section 72A related conditions. But if I acquire business, no way you will get the carry forward of losses. Compared to a share deal, I put it as amber or yellow. Reason being, depreciation, there is no 79 impact, the losses won't lapse, as such the unobserved depreciation will continue. Whereas all of your business losses are going to lapse so long as there is a change in shareholding beyond 49%. So step up in cost we just discussed, stamp duty and VAT. If I do the business deal or asset acquisition vis-a-vis a share acquisition, stamp duty is relatively higher because it ranges between 3 to 5% depending on the location of the assets and the risk appetite of the parties involved. VAT does not apply for slump sale but applies in case of asset sale. This if I compare with the share transaction, it is very clean because I just pay a stamp duty of 0.25%. That also can be mitigated if I am essentially dematting the shares. Am I being too quick or is it okay?
No problem.
Okay, thanks. So then we have got this problem of non-assignable contracts. Recently we were seeing a company which is in this urea field which has a gas connection from Gas Authority of India. So the whole value for the entire deal is only the gas linkage that they have got. Likewise, if you take a steel plant for example, the entire value will be typically the coal linkage as well as the steel linkage. And these contracts by definition would not be assignable. So if I say that I am going to do a slump sale and shift this contract along with the slump sale by putting it in the business transfer agreement, more often than not or very likely the contract would not get transferred because they would say that you have to reapply. If you have to reapply, that essentially means that the existing one will get lapsed and there will be a stoppage in the operations of the company. And also you do not know how many months or years this contract could take. So that becomes a very problematic sort of an issue. And one case that we recently handled, what we ended up doing is did the slump sale through the court process. So we have gone to the Bombay High Court to get the approval for the slump sale. Though it is not required, you can just do it at the company and the shareholder level. The objective from our perspective was that if the court blesses this particular scheme, where things stand today, it is you can take it more often than not, the other authorities are going to abide by it. Now the problem is from court it has now shifted to tribunal. We do not know whether the tribunal will be given the same level of importance because High Court normally has a higher standing from all authority perspective compared to a tribunal, that though companies are tribunal. That's on the non-assignable contract. On the seller's tax cost, I'll give an example here. Say if an investor has come from Mauritius, which is otherwise say treaty protected, he holds the shares in an Indian company and he wants to exit this. So if he was to sell the shares, only there is one level of tax which is capital gains tax on this transfer of shares. If you are protected under the treaty, that also would not be payable. And if even if treaty is not there, if the seller is a non-resident, the rate of tax is only 10%. This vis-a-vis, if I convert this share acquisition into an asset deal, what essentially ends up happening is the company that is selling has to be an Indian company by definition. It sells a business, it pays a 20% tax, capital gains tax on sale of business or assets as the case may be. You cannot apply any treaty, anything here because the seller is an Indian company. And then this cash that has come into the company, if you have to repatriate it up to the shareholder, then you have to do either a buyback or a dividend. Earlier, at least before 115 section was amended in like introducing buyback tax, at least you could have done a buyback, taken the treaty protection and did the buyback out. Now that also is not possible because there is a 20+% tax in the hands of the Indian company that undertakes the buyback. Dividend, again you have to pay tax, where the recipient is an Indian entity or an Indian shareholder, again you need to pay an additional 10% of tax. So effectively what could have been a 1-layer tax or even a 0 tax in case of share transfer ends up becoming a 2-layer tax in case of a business deal. So therefore more often than not you will see buyers pushing for a asset acquisition, whereas sellers would push for a share acquisition because I get the money entirely in my hands without any 2-layer tax, it's only 1 layer of tax. Also if there are invariably what happens is there will be some non-resident investors etc. They may end up getting money most of the times without paying any taxes. Goodwill purchase price allocation we have discussed. Reception to business in case of asset deal is high compared to a share deal. Can we move on? So the next point is on non-compete. So this is again has been debated quite a bit now. Service tax also is applicable on non-compete. Now the question is non-compete, broadly what you need to decide is whether it is part of the consideration, because if I am buying the shares, I can say that this deal is done with the understanding that the seller won't compete with me for a period of 5 years. Okay. Here what is happening is I am clubbing everything together and having a composite transaction value that is ascribed to the deal. I am not breaking it up saying for shares I am paying you 80, for non-compete I am paying you 20. So one way of doing it is just combine everything together. Other way is to break it up and give the separately. If I break it up and give separately, from a seller standpoint, it ends up becoming a business income. 30% tax needs to pay. On top of it, there would be a service tax implication on it. However, if I add up everything together, then you end up paying normal capital gains tax, what you end up paying on the transaction. And from a buyer standpoint, what happens is if it is paid together, you do the purchase price allocation, get done with it. However, if it is paid separately, we need to see what is the period of non-compete. If it is like up to 1 year, you expense it off. Up to 5 years, you treat it as deferred revenue. Like I'll take 20% hit every year and get done with it. However, if the non-compete is beyond 5 years, etc., which typically we don't get to see, there is a big risk that it could be construed as a capital expenditure where the buyer will not get a deduction. Next, moving on, share transfer. So here, I'll not spend much time on it because it is fairly simple now. There was some ambiguity for non-resident selling shares in an Indian private limited company, whether the 20% rate applies or 10% rate applies. That's been clarified with effect from 2012, saying that 10% is the rate that applies. Pretty much the period of holding everything will change, or it's 2 years for unlisted, 1 year for listed, etc. Which I think is fairly similar. Probably we'll skip through and go into other topics. Is that okay?
Yeah.
Stamp duty we have just discussed. Indirect transfer, again, what I'll do is what is very basic, probably I'll skip through. What is critical, we'll talk through here. So if there is an indirect transfer, and all of us know post 2012, if the value of the Indian company is more than 50%, then you need to pay tax in India, proportionate to the value attributed to tax in India. But now what I am going to focus is more on the treaty applicability for an indirect transfer. I put 3 structures here. First case, US company holds shares in a Mauritius company, which in turn holds shares in an Indian operating company. Here say the entire value of Mauritius is derived out of the shares in the Indian company. Now this particular sale, is it taxable under the domestic law? Yes, no? Answer should be yes, beyond 50 it has to be taxable. Now, if you want to apply the treaty, will you apply US-India treaty or Mauritius-US treaty or India-Mauritius treaty for the sale? I'm repeating, US company is selling shares in a Mauritius company, which in turn holds Indian company shares. Which treaty do we apply? Three options. India-US, then US-Mauritius. Treaty is not there, but still can be applied. Other is India-Mauritius. India-Mauritius or US-India? Who is the seller? US. Who is the party that is required to pay tax? US. So it has to be US on one leg. Now, am I paying tax in Mauritius or India? India. It has to be US-India tax, as simple as that. But here again, if you look at Mauritius company shares are deemed to be resident in India. So under section 9 it gets deemed. So that is another way of looking at it, like why India-US treaty should apply. Now for this transaction I go back to India-US treaty, and then article 13, if you have seen capital gains, it simply tells that capital gains arising to one contracting resident of a contracting state shall be dealt with in accordance with laws of both the states. So if an Indian guy gets capital gains arising in US, that will be taxable both in US as well as India as per the respective domestic law. If I pay tax in US as a source, I get a credit of it in India. So here I apply India-US treaty. But unfortunately, under the treaty, there is no exemption that is available. So effectively, I end up paying 10% tax in India if it is long term. Short term would be 40% of tax. Fairly clear? Second example. Most of the structures nowadays we are setting up with this in this mode post this Vodafone changes. We'll look through, also discuss after the treaty has got amended in 2016, still whether you will be entitled for an exemption or not. So here you got the US. I'm taking US because most of the investment ends up coming from US. US holds Mauritius 1, Mauritius holds Mauritius 2, and Mauritius 2 holds entire stake in an Indian company. Okay. Now 100% of value of Mauritius 1 and 2 are derived out of India. Say Mauritius 1 is entitled to treaty benefit. Now the question here again, Mauritius 1 is selling shares in the second Mauritius entity. Which treaty will you apply? India-US, India-Mauritius, Mauritius-US. India-Mauritius, because seller is Mauritius, tax is in India, India-Mauritius treaty you end up applying. Now here if you look at the treaty, what it says is transfer of shares in an Indian company by a Mauritian resident shall be liable to tax in India. Exceptional proviso to this is if the shares were acquired prior to 31st March 2017. Okay, this is the law as per the amended treaty. Now here the treaty uses the word shares in an Indian company sold by a Mauritian entity. Now here what is happening is shares in a Mauritius company is being sold by another Mauritius company. Is this liable to tax in India or exempt under the treaty? Literal interpretation. Because under deeming provision it says shares are situated in India, that doesn't mean that Mauritius company is deemed as Indian company. Only the location of the situs of the shares gets shifted. Mauritius company continues to remain a Mauritius company, so therefore this continues to remain exempt under India-Mauritius treaty, irrespective of when you acquired the shares or when you have sold. Even if you have acquired the shares after April 17, still this exemption will continue. So invariably most of the funds etc. are getting structured this way, like I am doing one exit currently. So they have got 2-layer Mauritius already and the buyer wants to be treaty protected. So the option was to acquire individual assets. The structure is you have got the fund which holds Mauritius 1, Mauritius 2. Mauritius 2 holds all their portfolio companies in India. So now they have found a buyer who wants to buy. There are two options that we are contemplating is to buy individual assets. If that is bought, it has to be bought before 31st of March. In case a deal doesn't happen, what we're talking through is do an indirect transfer where Mauritius 1 sells the shares in Mauritius 2. And then you claim the treaty exemption from a seller perspective. From a buyer perspective, eventually when he sells, what he is selling is shares that Mauritius 2 holds in other Indian companies, which was certainly acquired prior to 31st March 17. So therefore, they will continue to be treaty protected. So this is all